My dear friends and investors, welcome back to our monthly video on markets and investing. And this month, we won't talk about tariffs and wars, but we will talk about something more fundamental, something that we like talking about, which is the earnings and what trends these earnings are pointing us towards. But before that, we've had a very eventful financial year 2026 thus far, 2 months into this year. Obviously, as I said, we saw two big events unfold. One was the Trump tariffs and the second was the Indo-Pak geopolitical tensions and almost a war-like situation. Luckily for us, we did a great job, and we're happy that the war did not escalate beyond a point, and that is good news. As far as tariffs are concerned, we believe that the incremental marginal risks from tariffs are receding. While there is no finality, but we've seen several flip-flops, and as it always happens, that over time markets and market participants tend to discount the risk and start to feel more comfortable, and therefore we believe that even though the uncertainty of tariffs is still out there, its incremental impact on the markets should be less and less. Having said that, let's move to what we are here to really discuss. Finally, the fourth quarter earnings season is almost over and done, and it seems to be a reasonable quarter. As you all know, we love to talk about earnings trends, and if we look at the trend so far, of the top 500 companies, roughly about 416 companies have declared their results, amounting to about just over 90% of the total market cap. And what we see is that at a PAT level this time, earnings have grown at about 11%. So we are back to double-digit earnings growth. But if we deconstruct that between non-financials and financials, I think the tables have turned. Non-financial companies have delivered far better earnings growth at 14%, while financials have delivered a mid-single digit earnings growth of 5%. But overall, for a broad swathe of NSE 500 companies, we have seen earnings rebound back to double digits at 11%. Now, if we look at a big debate, as you all know, which is constantly running in the market, there is an overwhelming feeling that mid and small caps are expensive and large caps are relatively cheap. But if we were to deconstruct the earnings, what we find is a very different picture. If you look at the Nifty earnings in the fourth quarter, and almost 48 out of the 50 companies have already announced their results, Nifty earnings for this quarter is just up 3.3%. Yes, only 3.3%. And non-financials have done about 6.8, and financials are actually minus 3.5. And if you look at the NSE Midcap index, which is actually the index of 150 midcap companies, of which roughly about 129 companies we have the results, the picture is very different. The PAT growth is almost 28%. And if you look at non-financials, it is almost 34%, and financials is almost 18%. So while large caps and the Nifty might look cheap, but frankly on an aggregate basis there is very little earnings growth. And while mid-caps may look expensive, the earnings growth is very robust at 28% in Q4. And therefore, we believe that even if you look at the rebound from the lows that we saw in March and April, immediately after the tariff announcements on April 2, you will see that the small and the mid caps have actually bounced back much faster than the large caps. If we now deconstruct the earnings season and look at which sectors have actually surprised on the upside, which means that they've delivered earnings which are better than what the analyst expectations was, and which sectors have actually done worse off, it makes for very interesting reading. The number one sector where there was a surprise was energy, which is oil and gas and utilities. And the deviation was almost 30%. So they delivered 30% better profits on an aggregate basis than what was expected. And that was largely because of inventory gains by the oil marketing companies like HP, BP and IOC, which are typically in the nature of one-time gains, and therefore we cannot take them as more secular in nature. So if you take out the energy sector, then the top four sectors which outperformed analyst expectations were new age companies and e-commerce companies, where they declared losses which were much lower than expectations, capital goods, and almost 40 companies where they beat earnings on an aggregate basis by 18%, metals and minings by another 18%, and logistics by about 16%. But what is significant is, as I said, if you exclude energy where there is a lot of one-time gain, the next two sectors are new age e-commerce and capital goods. And as you all know, friends, we have a reasonably large exposure in both these sectors, and therefore we believe that that's good news, because where we have a significant exposure is where we have not only seen a solid YOY growth, but these sectors have also outperformed the general consensus expectations. Which were the laggard sectors? Building materials, chemicals, infrastructure, consumer retail, and the FMCG or consumer staple companies. These companies continue to deliver not only poor results, but they have also seen some downgrades, or they have delivered less than what the consensus estimates were. And finally, if we look at the last 8 quarters of earnings trend, as you all know that the Q1 and Q2 of last year were almost a washout, where we fell to single digit earnings growth. And finally in Q3 and Q4, earnings on a broad basis are bouncing back, and we've seen double digit earnings growth with Q3 at 15% and Q4 at almost 11%. What is interesting is that if we now move from earnings to how the markets have rebounded since April and May, the broad index NSE 500 is roughly up about 7%, with the best performing index being the Nifty real estate, which is up 15%, the Nifty media index, which is up 13%, the Nifty financial services index, which is up 12%, Nifty autos, which is up 10%, and Nifty chemicals, which is also up 10%. And what we can read through this is that clearly, if we were to remove the media index for the time being, then real estate, financial services and auto, all of these three are interest rate sensitive indexes, right? They tend to do well when inflation is coming down, interest rates are coming down, and as you all know, liquidity has substantially improved. So what we are seeing, and though this is just 2 months of trend and we cannot read too much from it, but what we can discern is that in the recovery phase, very clearly, the more interest rate sensitive sectors are doing far better. And while chemicals as a sector from a profitability did not do that great, but the sector has done well, we believe primarily because the market believes that the China plus one will be a big trigger given the kind of tariffs that have been put on the most competing country for us in chemicals, which is China. And therefore, we believe that what the markets in the very near term are signaling is that interest rates are going to come down, bond yields are going to fall, and liquidity has improved, and therefore NBFCs or capital market plays, autos and real estates will probably see a far better macro environment. Friends, now let me move to a more longer term trend. March 2025 culminates into 5 financial years post-COVID. And as you know, there was a new market trend, a new bull market which started post-COVID. And if we were to look at a snapshot over these last 5 years, what we see is very interesting. As we've always said, that the previous cycle was the cycle where broad earnings growth was very tepid. So to recount the numbers, if you look at the decade of FY10 to FY20, NSE 500 earnings growth was flat at 0.5%. However, the market cap CAGR was 7% and index CAGR was 6.5%. If you look at Nifty 50, for that same decade of FY10 to FY20, the Nifty earnings compounding was hardly 6% and the market cap compounding was 7% and the index, which is the Nifty 50 index compounding, was 5%. But if you look at the new decade which started from FY20 post-COVID to FY25, over these 5 financial years, the NSE 500 earnings have compounded at 31%. And this includes even a low earnings growth year, which is the recent year 24-25. If you look at the unweighted pure market cap of the top 500 companies, that's compounded at 28%, and the NSE 500 itself has compounded at 25%. What it means is that over the last 5 years, earnings CAGR is still higher than the unweighted market cap as well as the market cap. So the market cap is up 25 and 28%, but earnings compounding for the broader market is 31%. So there is still a catch-up that needs to be done on the broader markets. On the other hand, if you look at the Nifty over the last 5 years, earnings have compounded at 21%, the market cap unweighted has compounded at 23%, and the Nifty index CAGR has been 32%. So actually, the large cap earnings growth has been 21%, but market cap has compounded at 23%. On the other hand, if you take a more broader markets, then earnings have compounded at 31%, but the market cap has only compounded at 28%. So as we have been saying, that this popular belief that large caps are cheap, we believe that in the current cycle, barring a few exceptions, Nifty earnings are unlikely to compound going forward at very high rates. It would be great if they could compound in the corridor of 10 to 12%. We believe the real story of India in this cycle post-COVID lies in sectors which did not have a large representation in the index and were laggards of the previous cycle. And that's where we continue to believe that despite a short period of last 6 months when the more conservative sectors performed well in the markets, we believe that as the economy bounces back and as earnings bounce back, we believe that the cyclical sectors, manufacturing, capital goods, the same sectors which did well post 2020, I think that cycle will reassert itself. However, as you all know, we follow fundamentals very closely, and if the fundamental points otherwise, we are likely to change our view. But so far, the trends tell us that we just saw a brief period of a break last year because of lower capital spending. The cyclical sectors went in for a correction, but as I told you, that the biggest surprise in earnings actually came from capital goods. And while we believe that the recovery is well underway, the markets are continuing to respond, and we believe that this cycle, which started post-COVID, should last a couple of more years until the next cycle starts. Finally, I want to leave you guys with one more positive news, and that is the RBI dividend. This time, the RBI gave a very handsome dividend to the government. There was a little bit of a worry when the India-Pakistan war broke out, and because of the tariff issues, that probably will India be able to really achieve its fiscal deficit target that it has set out at 4.4%? Will there be a pressure on the government to spend more on defense? Will there be a slowdown because of slowdown in exports, and therefore will revenues keep up? But this handsome dividend by RBI, which is the highest at 0.75% of GDP, which is the highest in the last 5 years, should help cushion the government finances and should also help to keep borrowing costs lower and long-term bond yields softer. So we believe that the easy monetary policy, slowing inflation, and now the RBI dividend should all point towards falling interest rates, and that should help to spur economic growth over the next few months. Thank you, friends. Until the next month. Bye-bye.